All right, guys, we have my friend and cost segregation expert, Isaac Weinberg. Isaac, why don't you just give us a real quick rundown on who you are and the great company you work for?
Absolutely. So, first of all, I'd like to give a shout out to my dear friend Andrew. Andrew is a special person, an extremely kind person in today's day and age, when there's so much selfishness and caring about ourselves. Andrew's a guy who literally is one of the kindest people I've met. People connector, smart man, and it's an honor for me to be on this podcast. And if you're watching this podcast, just know that the host of the podcast, Andrew, is a guy you got to get to know even more.
Thank you.
Okay.
So nice.
So background of cost segregation. This is a hot topic that many investors talk about and actually put into their pitch decks when they send out deals to potential investors. So what is this cost seg idea and tool that many of us use? So we're all familiar with depreciation. Depreciation dictates that if you buy any investment property, and hence any investment property cannot be primary housing. That's a question I get asked all the time. It has to be an investment property that depreciates. A residential investment property depreciates over 27 and a half years, and a commercial investment property depreciates over 39 years, which is interesting because even though the market value is going up, and that's why we're all involved in real estate, because properties appreciate, the IRS and the government views that the property is going down in value due to the fact that it's older. So if you buy a multifamily property for $1 million, we'd have to subtract land because land never goes bad. So generally land is around 15%. So let's say we'll be left with 850 of a depreciable basis. The words I'm using of depreciable basis means what's left of the property that's that's allowed to be depreciated. And that depreciates over 27 and a half years. You will divide 850 by 27 and a half, and every single year you will get back, it's approximately 30 grand a year as a tax deduction. So if you made 200 grand that year, it will only be considered that you made 170 grand, and obviously you're going to pay less taxes. That is something that your accountant does for you. Cost segregation is basically depreciation on steroids. And the way it works is like this. Every property is made up of three different components. There's something called structure, there's something called land improvements, and there's something called 5-year property, which is carpet, flooring, chandeliers, light bulbs, door handles, etc. A regular accountant does not know how to segregate the property correctly, not because he's not a good accountant, but he's just not, he never learned how to segregate a property correctly because that wasn't his job. We come in, a cost seg team comes into the property. They identify all the 5 and 15-year components, okay? Generally on a multifamily property, there will be anywhere from 18 to 30% of the purchase price that consists of 5 and 15-year property. We'll find paved parking lots, landscaping, cabinets, flooring, etc. Now, what happens is that if we identify, let's say 20% of your property as 5 and 15-year assets, you can take those assets, those components, on a 5 and 15-year track. So instead of taking everything under long-term depreciation, which your accountant will do for you if you don't say a word to him, you're actually going to get certain items in your property on a faster track, and obviously that will result in bigger write-offs earlier on. Now, that was cost seg before 2017, before September 2017. In September of 2017, Congress instituted a law called bonus depreciation, which allowed for all 5 and 15-year components to be taken on year 1, okay? How does that work? We come into a property, we identify 20% of the components in the property as 5 and 15-year assets. Now, that Congress instituted, that you could go ahead and take all 5 and 15-year assets on year one. It's a domino effect that once we identify those assets as 5 and 15-year components, boom, it automatically is enabled to be taken on year one. But if you don't do a cost seg study to begin with, you'll never be able to correctly identify the 5 and 15-year components. And therefore, that will result in just long-term depreciation for all the asset classes. Sorry, for all the components in the property. So the idea of cost seg is really fast forwarding your depreciation. I always give the example to many people. If I would owe you $100, what would you rather? Would you rather $10 a year over 10 years? Or would you rather $30 in year one and then the remaining $70 over the following 9 years? Obviously, you would rather the $30, because even if you don't need it, take that extra cash and, I don't know, buy something small and sell it at a higher value. The idea is we all love cash. The more cash flow we have, the more money we have to invest, whether it's real estate, stocks, anything it could be. So the idea of cost segregation is to free up more cash flow, generally to invest it in more real estate. So that's really the background of cost seg and how cost seg works. The next, Andrew, tell me if you agree with this. I would maneuver right now into when does it make sense for somebody to do a cost seg, and when doesn't it make sense for somebody to do a cost seg?
Yeah, that's what investors really want to know. Yes.
Exactly. So everybody, now that we know what a cost seg is fast forwarding your regular depreciation and giving you bigger tax deductions earlier on to be able to offset your tax liability. Again, you're ultimately going to get everything, but you'd rather take it earlier on to offset your tax liabilities. When does it make sense to do a cost seg? So first of all, if you have a tax liability, right then and there, you already climbed the first step. That's when you should start talking to a cost segregation specialist. If you don't have a tax liability, many real estate people don't have tax liabilities. They pull out money from the properties. They're not showing active incoming income, and therefore they don't have to pay taxes. So if you're not paying taxes, if you don't have a tax liability to offset, obviously it's not relevant. But even if you don't have a tax liability, it could be your partners or your investors have tax liabilities that they'd like to offset by using this asset that you just purchased and doing a cost seg study on. Many, many times I speak to syndicators who tell me, hey, Isaac, cost seg won't benefit me because I'm not showing any income this year. So I ask them, what about your partner? What about your spouse? If you're syndicating deals, that means you're a real estate professional, which we'll get into soon, and you could offset your wife's income or your spouse's income or your investor's income. What about that? And they're like, hey, that's a great point. So if you, your partners, or your investors are getting hit with a tax liability, that is the first step to recognize that a cost seg study might benefit you tremendously. Now, another big component of knowing when it makes sense to do a cost seg study is if you're going to be holding the property for a few years, okay? And I'll really maneuver into when it's not worth it to do a cost seg study, because it's really one big picture of when it's worth it to do versus when it's not worth it to do. The idea of a cost seg study is very similar to a 1031 exchange. We're all familiar with 1031 exchanges. Even though you're deferring your capital gains, you're not actually erasing your tax liability. What you're doing is you're throwing it down the road. Now, there's one way to get out of capital gain tax eventually when you sell the property by 1031. That's if the actual purchaser, the buyer, dies and he hands it off to his kids. I think they call it swap until you drop by 1031. So, but eventually, if you sell it, you're going to get hit with the capital gain tax that you originally would have had. Same idea with the cost seg. The idea of a cost seg is you're taking your tax liability and you're throwing it down the road. You have $100,000 depreciation right We'll give that to you. We'll offset your tax liability. But if you sell the property, you're going to have to pay it back. Now, I don't want to get everybody confused. Let me rewind for a second. The IRS gives you these depreciation rights, assuming that you're going to hold the property for the full 27 and a half years or the full 39 years for commercial. 27 and a half for residential, 39 for commercial. But if you sell it after 5 years, you were never really entitled to those depreciation rights. So therefore, you're hit with something called recapture. Recapture means the same tax liability that you got out of, you will have to pay back later on. Okay? So generally, I tell clients, if you're going to sell within a year or two, don't do a cost seg, because how much could you already do with that money in a one tax calendar year? Now, a lot of people will argue with me and say, hey, that I could use that money and will be useful for me. But generally, it makes sense when it's 2 years and above. It's called time value money. Time value money means like this. I posted on LinkedIn around a week ago. If I would offer you a $100,000 interest-free loan for 3 years, would you take it? And obviously, everybody said back to me, Isaac, where's the dotted line? I'm ready to sign. Why is everybody so interested? Because of course I'll take an interest-free loan and I'll invest it in real estate and I'll make a lot of money. We call another way I refer to cost segregation when I speak to prospects and clients is time value money. Yes, you're going to go ahead and pay back that tax liability when you sell after 5 years, but you went ahead and spent right now anywhere from $3,000 to $6,000 on a cost seg study, enabling you to get your hands on huge tax write-offs. Now that you have those tax write-offs, you have liquid cash because you would have paid that to the IRS. You have that extra liquid cash in your pocket to go ahead and reinvest in more real estate. That's called time value money. So is it worth it for you to spend 3 to 6K on a cost seg study to go ahead and get that cash to reinvest in more real estate? I say yeah. And obviously, the bigger purchase that we're talking about, the more it makes sense. If we're just going to get a very small deduction, it doesn't make sense. But if you're getting a nice deduction, and most people that I deal with 5, 10, 15, $20 million syndication deals, it makes a lot of sense. And something that I want to add. So now that we covered recapture, and the idea of recapture is that you're going to have to pay back that tax liability that you got out of, I want to maneuver into the investors portal, the investors world. But before we do that, I want to end off with one thing. And this is something that many people don't know. Many people say, I'm going to get hit with recapture after 2-3 years. I don't want to do it. I don't want to deal with the headache, etc. I want to tell you a secret that many people don't know. And that is, you can use your depreciation rights to offset ordinary income, which could be taxed at 37.5%. Okay? That means you made 100 grand this year. Okay, obviously you're not going to get taxed at 37.5%, 100 grand. You made 400 grand this year, and you have a $400,000 deduction. You can offset your tax liability and get out of the possible 37.5% that you would have paid. When you get hit with recapture caps out at 25%. So if you take the two numbers, you're actually gaining tremendously. You're actually making money on the deal, even if you're going to sell it. And one other thing before we get into the LP side of things is like this. Is even if you're going to sell the property after a year or two, if you 1031 it, not only does a 1031 take care of the capital gains on the original sale, it will take care of the cost seg as well. So if you plan a 1031 on a property, even if you're going to sell it after a year, it makes sense to do cost seg because you will not get hit back with recapture. Okay? Recapture is the most talked about idea in the cost seg world for people who decide not to do it, but it's very well worth it to know the concept inside out and to actually weigh the benefits versus I guess the losses that would happen to you, which are not going to be that big. It could be very well worth it. Now, how does it work with investors and partners? So let's say like this: you have a syndication, you have a syndicator. He's doing it together with another partner, and they're doing the classic traditional 70-30 split. and they have a bunch of LP investors on there. The way it works is whatever the structure on the deal is, you will get an accelerated depreciation. For example, let's say you invest $100,000 in a deal and they're giving you 2% equity in the deal. You will get 2% of the accelerated depreciation. That is LP investors for dummies. Not that you're a dummy, but that's the simple way of understanding. Now, let's say you have a guy, it happens many, many times. You have a guy, he goes to syndicator, I'm not interested in operating this deal. I'm willing to write out a $700,000 check right now, but I need a lot of depreciation. The syndicator doesn't need it for some reason. He's not getting hit with a tax bill. The partner doesn't need it. He's not getting hit with a tax bill. He wants to give away his portion of depreciation to this big investor to make it more exciting for him. The answer is there's something called partnership agreement terms that you got to speak to your attorney, you got to speak to your CPA, and there's ways to revise and to edit and to restructure the partnership agreement terms in favor of the LPs, enabling them to take more than the actual structure would allow them to take. So that's something that many people have to know if you guys are LPs. But the other thing that is very, very important to know when it comes to cost seg, and this is something that I deal with on a daily basis, and we'll kind of end with this unless Andrew, you have more questions. The idea is, what can I offset? Can I offset active income with this depreciation? Can I offset passive income? Can I offset both? The answer is like this. There's something called REPS, R-E-P-S, which means real estate professional status. To become a real estate professional, that doesn't mean that you're a licensed real estate person selling real estate, you're an agent. Even though sometimes if you have a partnership in the actual firm, a 5% partnership, there are CPAs that say that will qualify you as reps. Reps means that you spend 750 hours a year or more in real estate, which can mean acquisitions, it can mean property management, it could be underwriting deals, etc., collecting rent. Somebody that's on a W-2, many times LPs are doctors and dentists and all these types of people, and they're on regular W-2s. If you're on a W-2, there's a 95% chance you're not a real estate professional. Because how could you be spending 750 hours a year in real estate if you're working from 9 to 5 or 9 to 6? You just don't have enough time in your day to do that. There are certain scenarios, if you actually are spending that time, you speak to your local Orthodox CPA, and he'll help you out and see if there's anything to do. The difference between being a real estate professional versus not being a real estate professional is vast and beyond. If you're a real estate professional, you could offset active income, which means, let's say you have a side hustle and you're selling stuff on Amazon and making $200,000 a month, $200,000 a year, or your wife or your spouse is making money and she's on W-2 income and you're filing jointly, you could actually offset active income, which is huge. If you're not a real estate professional, you can use the depreciation only to offset passive income. Passive income includes profits generated from proceeds from that property that you invested in, proceeds from other properties you invested in, anything on your K1. It could be the stock market. And there's also one more scenario. If you own a business and let's say you make your spouse into a passive partner in your business, so that's considered passive income, you could offset that as well. But that's something that you should explore because there's many times people call me up and say, hey, Isaac, I have 3 rental properties. Okay, I have 3 rental properties. I purchased them each for $700,000. Boom, I'm so excited. I'm going to be getting a couple $100,000 in first year benefits. I'm not going to have a tax bill. I say, wait up. Cost seg is magic. It's awesome. It's legal. The CPAs are into it. Amazing. But something you have to know before we even dive even one step further, you're only going to be able to offset your passive income unless your spouse is not on a W-2 income. You somehow put her name under a lot of the properties and you show the government that she's very actively involved and make her into a real estate professional. If you're on a W-2, it's going to be very, very rough to file as a real estate professional. And therefore, you're only going to be able to offset passive income, which many times is worth it to do a cost seg. I've had guys come to me this year. that had tremendous amounts of passive income that they needed to offset. But it's just something you have to know. So I just want to summarize for a second. When does it make sense to do a cost seg? When does it not make sense to do a cost seg? It makes sense to do it if you're going to hold it for at least 2 years. It makes sense to do it if you're going to hold it even for 1 year, but you're 1031ing the property. It makes sense to do it if you're getting hit with a tax bill. It makes sense to do it if you're a real estate professional. Now, obviously, you have to combine a lot of them together. If you're a real estate professional, but you're not getting hit with the tax bill, obviously not. But these are all the components and all the pointers that you have to know. I've seen recently, and many investors, many syndicators put it into their pitch deck that we plan on doing cost seg. We're going to X amount of dollars in depreciation, and that is part of their pitch, which changes the dynamic many times. Something that you just have to know, and this will end off with this, is that instead of 100% bonus depreciation, which was allowed the last few years, right now in 2023, for any properties purchased in 2023, you can only get 80% bonus depreciation. So 80% is still magic. That's still awesome. It's the best method to offset your tax liability, but you're just going to get a little bit less. That's the gist of cost seg. Obviously, if you want to know more, reach out to me. I'm very active on LinkedIn. I love to talk to each and every one of you, and thank you for listening. Andrew, do you have any other questions?
Yeah. Well, Isaac, the most important question: how do people get a hold of you?
Okay. Yeah. So I'm very active on LinkedIn. My information is there. I'm happy to share my email address and my phone number. I have no problem with that. I love connecting with people and talking preliminary numbers, actual numbers. And if you know Andrew and you're friends with Andrew, you're friends with me, because Andrew's my buddy.
Isaac, you're a good guy. Wonderful. Thanks so much for being on the series Spotlight. There's a lot of misconceptions, one, about cost segregation, and then two, when I talk to other investors, quite a few of them have no idea what it is. Literally do not know what it is. So you've done a great service for our community today. Thank you so much, Isaac.
Thank you, Andrew. You're welcome.